Hello traders and welcome back to the Forex Geek where we dive deep into the tools that can help you make smarter trading decisions. In today's video we are going to be talking about the Ichimoku Fibonacci Strategy, which is a powerful trading system that combines two of the most effective technical analysis tools available to traders. This strategy helps you identify high probability trading opportunities by finding confluence between Ichimoku Cloud components and Fibonacci retracement levels. So if you've been struggling to find reliable entry and exit points in your trading, this video will provide you with a clear systematic approach that can significantly improve your results. This is a rule-based strategy. Stay with me until the end as I break down exactly how to implement this strategy step by step, including real examples that demonstrate its effectiveness across different currency pairs. You will learn not only how to identify the perfect setup, but also how to avoid common mistakes that prevent many traders from succeeding with these tools. So without wasting any much of your time, let's get started. So first of all, let's define the Ichimoku Cloud. But before that, I'm just going to add it to our chart. Ichimoku Cloud. This is a trading view platform and we are on the 1 hour time frame. So let me just explain the Ichimoku Cloud indicator. It consists of 5 components that work together to provide a complete market picture. And these components include the Kumo. All right, we're just gonna keep this by the side here so that we can use it to explain. It consists of the Kumo, which is the cloud, the Tenkan Sen, which is the conversion line, the Kijun Sen, which is the baseline, and the Chiku span, which is the lagging span. And we have the Senku span A and B, which form the cloud itself. And these elements help traders identify the prevailing trend, momentum, and potential support and resistance levels. So that is it for the Ichimoku Cloud indicator. You can see it. All I've mentioned the conversion line, which is the blue line. See this blue line. And we have the baseline. These two lines interact. When you get a crossover, it's a signal for something in the market. And we have the lagging span, and also we have the leading A and B, and these form the cloud, the Ichimoku cloud. And that is that for the Ichimoku. And let's quickly talk about the Fibonacci. Fibonacci retracement is quite popular. It's derived from the mathematical Fibonacci sequence and it helps identify potential reversal points during price pullbacks. For example, we are in an uptrend here, so just gonna use the Fibonacci to find possible retracement levels, uh, possible reversal points during price pullbacks. And the key levels for traders to focus on are the traders can focus on the 38.2%, the 50%. You can see them here. These are the percentages. 38.2%, the 50%, the 61.8%, and sometimes the 78.6%. So these levels often act as support in uptrends and resistance in downtrends. For example, we are in an uptrend here. We should use these levels as support levels. Areas where once price gets to these areas, we should be looking for a retracement or a pullback to the upside. So the Ichimoku Fibonacci strategy works in both trending and ranging markets. In trending markets, it helps identify pullback entry opportunities, while in ranging markets, it can highlight potential breakout points. This versatility makes it suitable for various trading styles and timeframes, though it tends to perform best on the 1 hour and 4 hour charts and other higher timeframes where market noise is reduced, which is why we are on the 1 hour chart right now. So let's talk about the strategy. The first step to trading this strategy is to identify the primary trend. Begin by determining the overall market direction using the Ichimoku Cloud. So I'm going to put back our Ichimoku Cloud on the chart. So we should look for the market direction using the Ichimoku Cloud, and the way we do this is once price is above the cloud, it indicates a bullish trend. As you can see, price here is above the cloud. This is price being above the cloud, which is this, and that signifies we are in a bullish trend. Also, price below the cloud indicates a bearish trend. Price within the cloud, as you can see here, indicates a ranging market or consolidation. So as you can see here, we are above the cloud, so this is a bullish market. So that is the first step, identify the primary trend. Now, once we are done identifying the primary trend, the next step is to apply Fibonacci retracement to recent swings. Apply Fibonacci retracement to recent swings. So, for example, we have several swings here. I'm just going to remove the Ichimoku Cloud because it's kind of causing confusion here. That's just so many lines. So we have a swing from this swing low to this swing high. We also have a swing from this swing low to this swing high. And we also have this swing that got invalidated here as we change to the bearish trend. So that is the first step, is identifying the trend. The next step, which we are on right now, is applying the Fibonacci retracement to recent swings, and we have done that. So you should focus on key Fibonacci levels like the 38.2%, the 50%, and the 61.8%. Remember, we discussed that. So the next step is to wait for confirmation signals. You should wait for confirmation signals. So the power of this strategy lies in finding areas where Ichimoku components align with Fibonacci levels. So look for these specific confluences. I'm going to put back the Ichimoku Cloud. Please listen. This is very, very important. Now, the 38.2% retracement coinciding with the Tekken Sen. The second confluence is 50% retracement aligning with the Kijun Sen. Now, you should know that the Kijun Sen and the Tekken Sen are these red and blue lines. These two lines, those are the lines, and these lines should have a crossover signaling uptrends. The blue line, which is the conversion line, should be above the red line, which is the baseline, and this signals that we are in a bullish trend. So this should be in line. The 50% and the 30% should be in line with these two lines. So you can see here we have price reacting off of the 61.8%. We have the 61.8% here for this swing. We have price reacting off of that. Also, we have price reacting off of the 61.8% here. Actually, it went all the way down to the 78.6% here. So that is how you can use the Fibonacci and the Ichimoku Cloud. Also, you can look for price. The main thing is that price should be above the cloud, and also the blue line, which is your conversion line, should be above your baseline for a bullish trade. Now, once you've considered this, the next step is to look for support and resistance zones. In this case, we are looking for support zones using the Fibonacci retracement levels. So I'm just going to remove this, and you see our support levels here. We have this is 1.8%. So if you're looking to take a buy trade from here, you can just take one here and stop loss at the 100%, take profit at the 0%. Just target a fixed risk reward ratio of 1:2. The same thing happened here. We have our support level as indicated by the Fibonacci retracement level, and if you just take a buy, which your stop loss at the 100%, and take profits at the 0%, or you could target 1:2 risk reward ratio, but it's preferably put your stop loss, your take profit at the 0%, because is way better and helps to calculate your risk better, and also for your Fibonacci extensions. It's a major level you should look forward to. So let's look at bearish examples. Now, for short trades, we should look for price rallies to a Fibonacci level that aligns with an Ichimoku component. So for example, the first step is to look for price being below the cloud. You can see price here is below the cloud, which is the first step. We are in a bearish trend. Also, you can see that the red line, which is the baseline, is above the conversion line. So the Ichimoku component aligns and shows us that we are in a bearish trend and we should be looking for selling opportunities. So that is the first step. And the next step after this is to draw our swing points. We have a swing point here. We have another one here. Have another one from this high all the way to this low. We have another one from here all the way here. Remember, we are in a bearish trend, so these are just swing points. So remember, our key levels are 38.2%, 50%, and 61.8%. So looking at this, we have price reacting to the 38.2% here. We also have here price reacting to the 61.8% right here. Actually, this is 1.8% and the 50%. And here we have price going deep into the 78.6% before retracing. Yes. So these are Fibonacci levels that we can use for our resistance. And you can see price reacting off of these levels with ease. Okay, this is not a financial advice, but there's a short position ongoing here and is running already at 1:1.83. So we're expecting lower prices on Euro USD. And this for this short trade here, stop loss at 100%. Remember, take profits at the 0%, or you could just target 1:2 risk reward ratio all the way down. And for this example here, we have the 38.2%. So set your sell there. Stop loss could be at the 78.6% because it's the 38.2. So you put it at the 78.6, or this is the 1.8%, and targets all the way to 1:2 risk to reward ratio. So that's how you can use the Ichimoku Cloud and the Fibonacci retracement to trade in the Forex market. Remember, the first step is to identify your trend using the Ichimoku Cloud and the conversion line and the baseline. So that is very important. After that, you should plot your swing points, plot your Fibonacci on your swing points from your swing high to your swing low and from your swing low to your swing highs. Then after that, the next step is to look for key retracement levels, which is the 38.2%, the 50%, and the 61.8%. After that, you can take your trades when price gets to these levels and give us signs of pullback, signs of retracement. You can see this rejection here. See, there are several signs of retracement. You can see this engulfing, bearish engulfing, candlestick pattern right there, which signals to us that yes, indeed, we are looking to sell from this Fibonacci level. After that, you can take your trade and hit your take profits at fixed risk reward ratios of 1:2 or a 1:1 for a start. Alright traders, you've come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.